Hey guys, welcome to our YouTube channel. Today we're going to be talking about numbers, right? Numbers are that running numbers thing, right? That people talk about in real estate. Make sure you run your numbers. What the fuck does that even mean, right? So I'm going to simplify for you guys in thinking in four different components. I usually get these four components. I end up with five or six things. I like to talk a lot, but and I sometimes deviate, right? But um, I'm able to make it in a digestible format that you guys can actually absorb. All right, run your numbers, right? So let's get to it, right? The first thing you got to do is set your criteria. You have to either work with a wholesaler, work with a real estate investor that helps you identify and filter out what your criteria is, right? Single family, multifamily, commercial, land, whatever your property type is. That's number one. Number two, you're gonna kind of graduate from that into the pre-offer stage, right? Pre-offer stage meaning you have to evaluate what your repairs is going to be to get that property ready for a rental, right? What is the rent in that area, in that community, in that neighborhood, in that zip code, in that radius, right? What that is. What are your maintenance costs? Maintenance inclusive of mortgage, inclusive of taxes, inclusive of insurance, um, any repairs. And this is not the first set of repairs. This is repairs ongoing, right? Because you want to put money aside for any Murphy's Law repair. And then you have your miscellaneous expenses. If this is a property that has a backyard, that you have to fix the gutters, you want to put those expenses aside, right? Number three, there's this thing called the 2% rule, the 1 to 2% rule, that you divide your rent, say it's $2,000, divided by your purchase price. If that number falls between 1 and 2%, you're in a decent space. You're gonna make some cash flow, right? Now the cash flow, remember, it's up to you. It's what works for you. Some people are okay with $150 a door. I'm not okay with that number, right? Some people okay with 250 a door. Okay, 350, 400, 500 a door. That's fine. The higher that percentage, the better it is, right? Typically 1 to 2%, 3% great, 4% even better, right? Anything under 1%, again, depending on your criteria. Typically, and the reason people do 1 or 2% is because real estate is such a, I wouldn't say stressful industry. There's so much work you need to do to start off. With everything, you have to do work. But with real estate, it's like you're saying to yourself, wow, I did all this work and I'm only getting $150 a door after I pay maintenance, vacancy rates, loan repair, mortgage. I'm left with $150. I'm exhausted, right? Because it's taxing, right? Especially when you're starting out. That's why you have to make sure your numbers, and I'm trying to break it down as simple as I possibly can, but this is not a one size fits all, so just keep that in mind. Um, Again, the higher that percentage, the better you are. The lower that percentage, I would say is a bad deal, right? Um, the next rule of thumb percentage is the 50% rule, right? The 50% rule basically allows you to more or less calculate your cash flow, right? So what does that do? That says 50% of your gross input, right? So say you have a house that it gets you in at two grand a month, right? Typically 50% of those $2,000 are gonna go to expenses that are not mortgage, right? That are gonna keep you running the house, whether that is insurance, that is taxes, that is a water bill, that is repair, that is capital expenditures that you're putting in to fix those things. Now you're left with $1,000. That $1,000 is not cash flow. You have not taken into account the mortgage. The mortgage is gonna say it's gonna run you $600. So now you have $600 to pay for mortgage, which is an ongoing cost. You have to pay your mortgage, And so now you're left with $400. That $400 is your cash flow for that property, right? So that's a 50% rule. Again, guys, this is a rule of thumb, right? This is not a hard and fast rule that it should work for every single scenario. And I typically encourage these rules when you already analyze 100 deals in a certain community in a certain area, right? I don't recommend these rules for a newbie that has not done their due diligence. So anyone who says, oh, you can run the 50% rule, you can run the 2% rule, don't go by that. I think it's like basketball, right? Treat it like basketball. Like when you shoot 1,000 jump shots with your left hand, right, and you're at a game and you're up by 7, maybe you shoot with your left hand, right? You know, we're up by 7 anyway with a minute left on the clock or 30 seconds left on the clock. You're gonna shoot with your left hand. There's a great chance you're gonna make it because you already shot it 1,000 times in practice and you've been doing it for a while. So to shoot it with your left hand in a game to you is like it's a walk in the park. That's where I would sort of recommend these rules, right? You're very familiar with the neighborhood. I cannot go to California and try to apply these rules. I'm not familiar with that market. I cannot go to Cleveland, although I evaluated that market, but I'm still not familiar with Cleveland. And put these numbers in. They won't meet my criteria, right? Sometimes these numbers meet your criteria. Sometimes these numbers do not meet your criteria. So it's important that you guys become familiar with the community, with the criteria, with the neighborhood, with the market that you're investing in. So let's run from the top again. You have your criteria. I'm going to reemphasize on that because I see a lot of these on social media and blogs. I make $800 a door. Okay, what market are you in, right? That you're making $800 a door, $900 a door, or how are you calculating your numbers? Some people just pay the mortgage, insurance, mortgage, insurance, and taxes, and they don't even save. Everything else is cash flow for them. I don't do my numbers that way just because I take into account Murphy's Law, and you're running a business. You don't want to be a slum landlord either. Look, where you have to borrow from Peter to pay Paul. So I try to have each property have their own sort of buffer zone. At least I try to do that the best I could. Anyway, so moving on. So you have your criteria, you have your 1% and 2%. I'm sorry, you have your criteria, you have your pre-offer stage where you're already analyzing, your repairs, your rent, your maintenance, and so on and so forth, your miscellaneous expenses. Then you have your 1% or 2% rule, and then you have your 50% rule, which helps you to identify your cash flow, right? Remember, 50% of your gross income or input that you're getting from your tenants is going to go into expenses minus the mortgage, and then you're going to subtract the mortgage from the remaining balance, and that's going to be your cash flow. The last item is the 65% rule. Some people quote the 70% rule. I quote the 65% rule just because I like to be on the conservative side. I don't want to assume, especially the way things are now, that banks are going to lend you 70% off the repair value. I'm going to go with 65% just because I like to also take into account hard money lenders and things of that nature. So let's go with the 65% rule. The 65% rule pretty much states that you're not going to pay for a property, and a lot of this goes to flippers. Use this rule, people that flip houses. Although I use that rule for buy and hold as well. But the 65% rule pretty much states that you're not going to pay more than 65% of the property after it's repaired. Let me walk you through a quick example. A property is worth, after it's said and done, brand new, after it's completed and repaired, is worth $300,000. All right? And you're looking at it and you're like, okay, if that property is worth $300,000, all right, and you evaluate it with your contractor, and your contractor says to you, you know what, it's going to cost me in or about between $40,000 and $50,000 and $45,000 to get this property repaired, to get it to $300,000. You're saying to yourself, okay, I'm gonna go with 50,000. So in your head, you're saying this, right? You're running your numbers. You're saying 40 to 45. I'm gonna go with 50,000. So it's gonna run in 50,000 to repair it. So the 65% rule pretty much states I'm gonna grab my 300,000, which is the which is the after repair value, ARV, after repair value, and I'm gonna say 300,000 times 65%. That gives me $195,000. But you're not offering $195,000 because, again, you haven't taken into account the repairs. So you're gonna say $195,000, and I'm gonna subtract $50,000 because that's in or about what the my contractor evaluated in terms of repairs, labor and material to get this house up to 300,000. So that leaves me with 145,000. So that's my offer, right? Because you want to, number one, you want to make sure that you take into account the repair cost that is going to get it to 145,000, right? And then you also want to make profit as a flipper or as a buy and hold person, right? Or if you're going to, most of these take into account carrying costs, most flippers use hard money loans. So you want to make sure that you're not getting the bad end of the deal here when you're offering an offer for a property that needs repairs, especially property that are inhabitable. You want to make sure that you're offering an after repair value. I'm sorry, you're not offering more than 65% of the after repair value for many reasons. It's not just because you don't want to offer it and you won't make money, but a lot of banks won't even lend you after it's repaired. For you to pull that money out, won't even lend you more than 65% after the loan to value or the after repair value. The banks, a hard money lender, they just won't do it. They need that cushion to make sure that they get their money, right? And so those are the 4 items that I hope I've simplified it for you guys. The last one is you need to be a seasoned investor. A newbie can certainly do it as well if he feels gutsy to do it, by any means. If you feel comfortable, handling projects and you feel you're a contractor, you can do it. By all means, I'm not trying to hinder anybody from doing it, saying newbie or seasoned. I know some seasoned investors have gotten burned because they have not used the 65% rule. I know a few of them actually. I wouldn't say a few, but I know 1 or 2 that forgive the noise, but I know 1 or 2 that have lost their shirt because they don't take those things into account. You can't just look at a property and just to buy it without understanding the after repair value and understanding the amount of effort and money is going to take to get that property up to speed. So guys, those are my 4 components. I'm hoping you were able to digest these. Guys, so those are my 4 components: criteria, pre-offer stage, 1 or 2% rule, 50% rule, and 65% rule. Again, that's 5 components. I threw in the pre-offer stage because you have to kind of figure that one out as well. But I'm hoping this video has helped. If you have any questions or I missed anything, please feel free to leave it down on my comment section. Like, subscribe, and share. Peace.